Warren Buffett, the most successful investor of all time, just sold another 100 million shares of Apple. He is now down to a 2% stake in the company. But why? After buying into Apple in 2016, Buffett had repeatedly referred to the company as a crown jewel of Berkshire Hathaway. He had even called Apple the best business in the world.
I mean, we own 5.5% or a little over percent of Apple. It's probably the best business I know in the world. And we own 5.5% of it. And that is a bigger commitment that we have in anything except insurance and the railroad. So it's our third largest business.
Yeah, it made the point that it was bigger than your biggest acquisition, Precision Casualty.
Oh, sure. No, it's our third largest business.
Apple seemed to fit all of Buffett's investment criteria. It's a strong brand with loyal and highly attached customers, a moat from their product ecosystem and switching costs, and strong management with Tim Cook as CEO.
The iPhone, has a terrific moat. I mean, people that have an iPhone, or maybe have some other phone, but they want to continue with the product that they've got. They want the new version. It's just easier for them. They've learned how to do everything, and their life's built around it and all of that. And moats are very useful.
The smartphone is the most important product in every modern person's life. If you don't have your phone with you, you feel like you lost a limb. And the iPhone has a dominant position in that market. Yet the man whose favorite holding period is forever continues to sell more and more Apple in 2024. In today's video, I'm going to share the 2 reasons that Warren Buffett has shared publicly for why he's selling Apple stock. Finally, I'll give my updated stock analysis on Apple. That will include a look at financial trends, price targets, and an estimated intrinsic value for the stock. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. So as I mentioned, Warren Buffett has been selling Apple stock throughout 2024. There was a sizable reduction after Q1, a massive reduction in Q2, and another 100 million shares sold in Q3. And Warren Buffett has actually not said anything about these recent sales, but during the 2024 Berkshire Hathaway annual meeting, he was asked a question about them starting to sell Apple stock, which had already happened then. So this is how he first responds to the question, and then I'll provide his 2 reasons that he gives.
Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
No, I would. But we have sold shares, and I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have now. One interesting thing is that Charlie and I looked at common stocks or marketable equities, or the things that people love to look at, as being businesses. We own American Express, which is a wonderful business. We own Coca-Cola, which is a wonderful business. And we own Apple, which is an even better business, unless something really extraordinary happens. We will own Apple and American Express and Coca-Cola when Greg takes over this place. And unless something dramatically happens that really changes capital allocation, a strategy, we will have Apple as our largest investment.
And despite this massive selling of Apple stock, it still is Berkshire Hathaway's largest investment. In Berkshire Hathaway's public stock portfolio, Apple is still the #1 holding at 23.1%. That's $67.5 billion of value. And that also goes to show how massive that position was prior to the selling. I would also like to point out that American Express is the #2 holding, and they own 21.5% of that company. And Coca-Cola is the #4 holding with a 9.3% ownership stake. And this latest sale of 100 million shares happened in the period before September 30th, So if we assume an average sale price of $220, then that would be $22 billion of cash for Berkshire Hathaway. Warren Buffett's company, Berkshire Hathaway, now has $325.2 billion of cash and short-term investments. This is a record cash position. It is actually crazy how much money that is. And so far, he has $290 billion of that allocated towards short-term investments, which he has said many times is US Treasury bills. So he is getting a risk-free rate of return of around 5% on $290 billion. And later on in that exact same question I played earlier, Warren Buffett brings up how favorable cash is at this time for a reason why he's selling Apple.
But I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available in the equity markets, and I look at the composition of what's going on in the world, we find it quite attractive.
And from a fundamental perspective, it's really hard to argue against that. $290 billion getting the highest risk-free return in decades, while the market is trading at relatively high valuations. Berkshire Hathaway is in an incredible position of financial strength with their $325 billion of cash and short-term investments. They are literally ready for anything, whether it's some major acquisition or a stock market crash they can go on a buying spree in. But the real thing about building this cash position is it gives Berkshire Hathaway so much flexibility into the future. They now have negative $185.8 billion of net debt. This company is a financial powerhouse, and they continue to grow revenue and free cash flow. Warren Buffett is now 94 years old, and I have no doubt that he wants to make sure Berkshire Hathaway is handed over in the best position possible. Current market cap is now $1 trillion. So it's really hard to argue with his first reason of just building up the cash position in this current environment, but it's his second reason that I personally don't think is that good. His second reason was about corporate taxes, and remember that this was in the spring when he said this.
We are paying a 21% federal rate on the gains we're taking in Apple, and that rate was 35% not that long ago, and it's been 52% in the past when I've been operating. And I would say with the present fiscal policies, I think that something has to give, and I think that higher taxes are quite likely. If I'm doing it at 21% this year, and we're doing it at a higher percentage later on, I don't think you'll actually mind the fact that we sold a little Apple this year.
Now, I agree that the US has some major budget problems, and political history points to spending only going up. And in the US, we will likely have a big negotiation coming up for taxes as the 2017 Tax Cut and Jobs Act expires for individual tax cuts. So that means a new deal would have to be done. And if it was a Democratic administration, part of those negotiations would likely be that they would want corporate taxes to go up. This is something they've campaigned on for many years. But that didn't happen. We had a Republican sweep, and Trump has said, if anything, he wants to try and lower taxes even more. So at least for the next 4 years, it seems like Buffett's speculation will not play out. He and Charlie Munger have also said for a long time that you should not try and time macroeconomic factors or tax rates and these kind of things that you can't control. So this is a little bit of a surprising reason coming from Buffett. Overall, though, I would still say Apple is an extremely high quality business. However, there are some factors that would make me a little cautious about buying Apple stock right now. And you definitely can make an argument that it was possibly a good time for Buffett to sell. And a lot of that has to do with slowing growth of the iPhone. I'm about to do a full stock analysis on Apple, and to do so, I will be using my research tool, dividenddata.com. There you can use my new AI analyst where you can ask practically any investing question. You can ask it to write you a report on a company, summarize the latest earnings, use a stock screener to find companies that fit the exact financial criteria you're looking for, and even do a discounted cash flow analysis on a stock. And of course, great data visualization so that you can understand the long-term trends impacting a company. This is all designed to help you save time and invest smarter. If you sign up today, you can get 50% off for life. This is to celebrate the launch of my new AI chat tool. Just click the link in the description or pinned comment and you can get 50% off instantly. Or create an account via our web app, select your plan, and enter the promo code AI at checkout. That's the 2 letters AI. If you have investing questions, ask Dividend Data. If it helps you find just one better stock, then it more than pays for itself. So let's do a stock analysis on Apple, ticker symbol AAPL. The current stock price is $225 per share, and this is only slightly below its $236 all-time high. But what's interesting is that Apple's stock price has continued to grow in recent years, despite flatlining earnings over at Apple. But before we get into their long-term financial trends, let's understand how Apple actually makes money. Their largest segment, by far, is the iPhone at 51.4% of revenue, or $201.1 billion a year. And for those of you who have not analyzed Apple stock before, you may be surprised to know that services is actually their second largest source of revenue at 24.59%, or $96.17 billion. This includes their digital content stores, such as the App Store, where they have a very large 30% fee. It also includes Apple Care, iCloud, licensing, and other services. More examples include Apple Music, Apple TV Plus, Apple Arcade, Apple News Plus, and Apple Pay. And this entire services business is really an extension of Apple's moat. They have such a dominant position in the iPhone and their whole product ecosystem that they can continue to add these new services and further monetize that customer. I'll talk more about that services revenue in a second. Third is their wearables, home, and accessories revenue at 9.5%. And there, the 2 big behemoths you have to talk about are the AirPods, which is my favorite Apple product. I'm not going to lie. I love those things. And the Apple Watch. That is 9.5% of their revenue, or $37 billion. You have the Mac coming in at 7.67% of revenue, or $29.98 billion. And finally, you have the iPad at 6.83% of revenue, or $26.69 billion. And here you can see a breakdown of Apple's revenue by product segment. And there's 3 main points I want to bring up here. First off, we have to talk about the iPhone because that is their #1 business segment by far. It's the core pillar of their business. It's where they make most of their money. And revenue growth for the iPhone has completely flatlined. It has had no growth for 3 years, and it looks like it's probably on track for no growth again this coming year. And the reason why is everyone already has a smartphone. The smartphone itself is no longer a growth category. It's become such a great product, everyone already has some version of it. It's very hard to exist in the modern world without a smartphone. So the only way Apple can grow this revenue is convincing people to upgrade their iPhone more frequently. And the problem is that the product has gotten so good in the past 5 years that there's very little improvements from each iPhone to each iPhone. I have the iPhone 13 and I really can't think of a reason why I need to upgrade right now. The upgrade cycle is now extending more to 3 to 5 years. And that lack of growth in Apple's biggest business is a problem if you're investing in Apple stock. However, the iPhone is still an incredible business, and it does itself still generate a lot of cash flow every single year. It should also be noted that Mac revenue and iPad revenue is flat to declining over the past few years. But if you're bullish on Apple stock, you need to be bullish on how they can monetize that product ecosystem outside of hardware. Services is the biggest growth business at Apple. Since fiscal 2012, services revenue has grown from $12.8 billion all the way to $96.1 billion. And in the past 3 years, that has grown from $78.1 billion to $96.1 billion. Services can be a real growth business for Apple. I also think this wearables and accessories revenue can turn into a growth business long term again. They've also been flat for the past 4 years, but you can see that they grew massively as they introduced AirPods and the Apple Watch. So Apple's product business is really just going to be flat until they have that next hit product. And that could come through accessories, maybe it's glasses or something like that. But until then, all the growth at Apple is going to come from services and monetizing their existing customer relationship and product ecosystem. And the company can do very well doing just that. Apple generates $108 billion a year of free cash flow, and they put the overwhelming majority of that towards stock repurchases. As you can see, since 2012, the company has just bought an insane amount of stock back. The shares outstanding have nearly been cut in half, and they are still buying back 2.5% 1% of the shares outstanding every year. And when you look at everything on a per share basis, which is really how you should think about it as an individual investor, that kind of juices the stats a little bit in Apple's favor. The 5-year compound annual growth rate of revenue per share is 12.59%, and the 3-year CAGR is 5.18%. So again, on a per share basis, Apple does seem to be growing a little faster than their raw numbers show. That said, net income per share has still seen a large slowdown, while free cash flow per share has grown at a 17.33% 5-year CAGR and 8.41% 3-year CAGR. The company still has a great balance sheet and they generate so much cash, but on the negative side, they have been buying back so much stock and some of that has been funded with debt. The company now has $41.45 billion of net debt. Now again, this isn't a problem considering they generate $100 billion of free cash flow a year. They could pay this off in less than 2 quarters. So not really a problem at all. It's just if they didn't buy back so much stock, they'd have a crazy amount of cash. They would have more cash than Berkshire Hathaway. And aside from buying back stock, they do pay a growing dividend, although it's on a very conservative basis. It's a quarterly dividend that's currently $1 per share annually. That's a 0.44% dividend yield at the current price. The 10-year compound annual growth rate of the dividend is 7.84%, but this has actually slowed down in recent years to 4.35%. The most recent increase was 4.17%, and the one prior was 4.35%. And this dividend is super sustainable at a 14% free cash flow payout ratio and 16.25% earnings per share payout ratio. So the Apple dividend is small in terms of yield, but it's very sustainable and it will continue to grow over time. There's no doubt that Apple is a great business, but growth is slowing at the company. At the same time, they trade at a premium valuation. They trade at 32 times annual free cash flow per share, while they're not really growing. And I'm very sure Warren Buffett has noticed that if they don't start growing, that valuation may become compressed because that's a really high multiple for something that's not growing. So let's try and value Apple stock, first using analyst price targets and comparing that to the current price, and then doing a discounted cash flow valuation on the company. The average price target for Apple stock among 42 Wall Street analysts is $244.48. That would imply 8.6% upside from here. The highest price target on Wall Street is $300 and the lowest is $184. So I would say that Wall Street analysts are quite bullish on Apple. And on a scale of 1 to 5, with 1 being the most bullish, the ratings are 1.89. So I would definitely say Apple stock is being priced with a lot of bullish sentiment. However, if we do a discounted cash flow analysis, it gets a little less pretty. When I ask my AI investment analyst to do a discounted cash flow, it will autofill all the data specific to a company. So I'll first give you what the default response was on Apple stock discounted cash flow, and then I'll go and edit the financial metrics to kind of match what I think will happen over the next few years. So the default entries gave it an implied share price of $158.75. And with a current share price of $225, that would make the stock 29.44% overvalued. So there would be a potential downside of around 30%. For example, like the 0 revenue growth rate in 2028 and 2029, and the growing capital expenditures, considering that they have actually been cutting capital expenditures in recent years. And I also give a couple different examples using different exit multiples based on free cash flow. I'm going to plug in these future revenue growth rates. I went kind of conservative and put it at 3.85% for 2028 and 2029. And I changed the expectations for CapEx to basically slowly decline for a couple more years and then flatline out. And I'm doing this based on the recent trend of them cutting CapEx. I'm going to keep the same free cash flow multiple they had of 24.65. And basically what this is doing here is it's projecting what future free cash flow will be for Apple. And then it's assigning a multiple of what it will trade at relative to free cash flow. And it's using that to estimate the stock price. And based on that, there is an implied share price of $194.05, which is 13.76% downside. So again, this shows Apple stock to be overvalued based purely on free cash flow. And if we want to be generous and assign a higher multiple to Apple of say 30, which is closer to what it trades at right now, with that higher multiple of a 30, that gives it an implied share price of $227.44, which actually would signal 1.09% upside. But I would say that's a very, very generous calculation for Apple. It's assuming much higher revenue growth over the next few years than it has actually experienced in recent years. And again, if you want to try out this exact same calculator and edit all these different variables, then sign up at dividenddata.com and just ask the AI tool to do a discounted cash flow analysis for you. And it will bring up this calculator auto-filling with all the specific stocks financial data. I may do a full video on discounted cash flow in the future because I think that will also help me learn it better as well. Let me know in the comments if you're interested on that. In conclusion, I think Apple is a very high quality business and arguably, in terms of quality, the best business in the world. However, growth has slowed down massively on their number one product segment, the iPhone, and the valuation is at the historical high end. So I can definitely mentally see how Warren Buffett got to the decision to sell a big chunk of his Apple investment. I get it. It makes sense. Would I have done it if I was him? I don't know. Would Charlie Munger have advised him to do it? Probably not. If you enjoyed the video, please leave a like, comment, and subscribe to the channel. If you want to use the research tool I showed throughout, then sign up at dividenddata.com. And if you join today, you can get 50% off for life. This is the best deal that will ever exist for dividenddata.com. So get it while it lasts. Click the link in the description and pin comment to get the sale instantly, or create an account on the web app, select your plan, and enter the promo code AI at checkout. That's the 2 letters AI. Thanks for watching, and I'll see you in the next video.